Hey, it's Jack from Jack Gately Real Estate and the Online Real Estate Academy. So last week we were talking about non-farm payrolls, and as I did that stream, I realized that I really wanted to talk deeper and take a deeper look into the job market, and we're going to do that over the weekend, but doing it now. And as we kind of look at the conventional wisdom about where the economy is going, where the economy is now, versus what is actually happening, there is a significant divergence between all the financial press that you see out there and the actual data on the charts. So that's very, very concerning because everyone in the economy or economic press is saying that we're going to have a soft landing and maybe a little bit of a slowdown, followed by some rate cuts. And the rate cuts will then fuel a huge comeback in the economy. And I guess that really depends upon where we are to begin with. And that's what we're going to focus on this video. But, I want to bring up this conventional wisdom from Yahoo. This video they posted today, Yahoo Finance. The U.S. economy is returning to normal. What this means for Biden.
Wall Street is debating when the Fed will start to cut rates and whether the U.S. economy will achieve a soft landing. But in terms of the health of the economy, there may be an easier way to evaluate it. Recent economic data show the U.S. economy might be finally getting back to a pre-COVID normal. Yahoo Finance's very own Rick Newman.
So this is the conventional wisdom that we're back to normal or approaching back to normal. We're going to dispel this myth in this video, but let's first hear what they have to say.
Has the story. Rick.
Hey, guys. So we got 199,000 new jobs in November. I looked up what was the average monthly job creation during the 8 years prior to the COVID outbreak in March 2020. Guess what? It was 196,000. So,
all right. So if you haven't been following along, this guy's kind of an idiot because he doesn't even factor the fact that about 30,000 of the new jobs are returning strikers from the writers' strike and from the auto workers. So the real number of people or new jobs created was about 168,000. So he just blows away that number. He doesn't even acknowledge that a hunk of the people that came back to work were from those strikers returning to work, which isn't actually creation of new jobs.
and I think that would be
I just don't think that's true. We're going to look deeper into that.
Great news for everybody if we could just get beyond all of these distortions in the economy that were caused by COVID, including inflation, and get back to what just feels like a normal economy where we're not always trying to figure out why are things so weird. Inflation is not there yet. The pre-COVID average was around 1.6%. It's around 3%.
Inflation's not there yet. And that is the big question that we're all struggling right with. When are things going to go back to normal? And when you actually look at the job numbers, you can see that we're really not back to normal. I think we're in this period where we're really hoping things could be better. We're looking and we're saying things should be better, things could be better, and therefore we're kind of coming up with this dream that we're going to have a very soft landing and then rate cuts. I'm not thoroughly convinced about that. And I was looking at some data because I wanted to do a deep dive on those farm payroll numbers, non-farm payrolls that came out on Friday. And fortunately, I was able to find an article that covered that. By the way, looking into the market today, we're looking at Dow futures relatively flat, the 10-year at 4.274. So mortgage rates are going to be coming in at about 7.1, maybe a touch shy of that later today on the Mortgage News Daily number. But I found a article here that really dove into the labor market and to see exactly where we are coming up out of this recession or out of the pandemic. Are we back to normal, as the Yahoo guy just said? Let's take a look at some charts. So all credit here to FX Hedge, the newsletter. You should subscribe. Why the economy is worse than it looks. The numbers say we're at the cliff. Countless indicators pointing to a recession in early 2024, but most economists are now completely ignoring them, forecasting more growth along with interest rate cuts at the Fed. It's hard to blame them, since many of these recession indicators have been flashing red since in January, and we're still waiting for the crash. I think that is true. I mean, there's this psychological aspect where we've been told this recession has been coming, and it's just never come. And after a while, you kind of get fatigued waiting for it to come. And you're like, okay, it's not coming. The bus isn't coming to pick me up. Somehow I missed it. And like, we've kind of like, at this point, we've been so waiting for the recession, we've kind of talked ourselves into thinking it's not going to arrive. And I'm not too sure about that. Everyone here, the key here is that everybody's missing the lies in the very data being dismissed. A classic case of not seeing the forest through the trees. We take a quick dive into the labor market numbers. So let's bring up the first chart. Even after the lockdowns ended, millions of people never returned to the labor force. Before that, the trend of those categorized as not in the labor force had been trending down. Today, the gap is in millions of people. So we mentioned this on Friday when we talked about the labor participation rate. And this chart here is not in the labor force per thousands seasonally adjusted. And as you can see, there was a trend down of people not in the labor force, and meaning that people would be going back to work. That dotted line there was the expected number of people going back to work. And the people not working spiked in early of 2020, as you know, and it stayed up there. As you can see, we have about, in this chart here, 100,000, and this is in thousands, and that has remained relatively steady, way up there and way above the expected trend line, where people were expected to go back to work if there had not been a pandemic. In other words, plainly spoken, we've got a lot of people that were going to go back to work and now haven't. Next chart here. Oops, sorry about that. Likewise, we see similar size gaps with the employment to population ratio. You can see the pre-pandemic trend and then the huge divot for the pandemic itself. And we have not regained that trend yet. Again, this is employment to population. We're just not working as much as we were pre-pandemic. Let's bring up the next chart. When we look at the employment per thousand seasonally adjusted, way off on that chart. Way off on that chart. You see the pre-pandemic trend. We have not bounced back to the trend line. When you look at the total of non-farm payrolls seasonally adjusted, also not bounced back to the pre-pandemic trend line. This data affects both the numerator and the denominator. This is what we wanted to get into in Friday's video. In the unemployment rate. In other words, the unemployment rate the other day ticked down to 3.7%. And we've been previously that it was at 3.9. What was interesting about that is that the labor participation rate actually went up. So you would think that employment. So this is kind of a statistical fluke, really, for now. But when you factor in the number of people that are not even seeking employment, but would otherwise be qualified to work, that is the true unemployment rate, or the true not working rate, if you want to think about that. Remember, the government doesn't count you as unemployed after a certain period of time and or if you quit looking. So if we look at the real unemployment rate, and this means people that are not productive in American society and or are somehow working in some type of underground economy, this affects the numerator and denominator, as we said, yielding a modified rate, in other words, a real unemployment rate of somewhere about 6.1 to 6.8%, because it accounts for the missing 4.3 to 5.5 million people absent from the official calculation. So our official unemployment rate is now somewhere, what did I say, 3.7-ish? But the actual real world number that is not reflected in the government statistic is more like 6% plus, 6% plus. When we're looking at the next chart, and I think this is by far the number one important chart when we want to take a deeper drill on these job numbers. We've also seen a boon in government jobs, although which is unsustainable, is goosing the headline job numbers. So this chart is just amazing. So once again, a little context goes a long way. And this is what I was concerned about when we did that non-farm payroll video on Friday. When you look at the job numbers, the number one category is healthcare for growth. Now, when you look at healthcare, what really is healthcare? A huge number of these healthcare jobs are actually government jobs filtered through the nonprofit sector. They're funded in part or in whole. Not all of them, not saying all of them, but a lot of them are tacitly or secondarily government-funded jobs, which do not produce productivity in the economy. Yes, they put money in people's pockets, but it doesn't create value. The second biggest category of new jobs is the government itself. None of those jobs create value. None of those jobs create value. None of those government jobs create value. They suck money from the private economy, which does create value, and they create no value. So it's a net loss. It's a net loss. Then the number one category here is leisure and hospitality, because experiences are way up. Plus, we spent like 2 years or whatever stuck in your house. And so you want to go out and have experiences. Experiences seem to be more important than physical things right now. And I can attest to that myself. I'm taking my family to Manhattan for the Christmas week. We're not going for the whole week. Actually, only staying one night because it's super expensive this year. But it's something that it will be an experience, something we never forget. And I'm looking forward to that. I've been very fortunate to be able to take my family to Manhattan several times over the last decade. It's an exciting thing to do. My daughter loves it. We love to go out shopping. And there's so much to do in Manhattan, right? Show, sporting event, so much to do. We've been there a lot. I'm not a big fan of the whole politics of New York, but I do like it to visit once or twice a year. And other people are doing all sorts of similar things. But when you go down this categories here, you see construction, not many jobs there. Professional services and business, kind of anemic when you compare it to the government and healthcare line items. Private education, lame. Wholesale trade, lame. Financial activities, lame. Mining and lodging and utilities, logging, I said, mining and logging and utilities. The government, if you haven't noticed, the government is at war with mining, logging, and utilities. So it's not surprising that those numbers are incredibly low. Manufacturing, even no growth in manufacturing. When you talk about a category where there is this actual positive physical value added, like you went to a factory, you had this bunch of raw material, and out the other end of the factory is now a widget where it's tangible value added manufacturing, zero growth in jobs. That's not good. That's bad. Retail trade, loss of jobs. Transportation and warehousing, loss of jobs. Information, loss of jobs. Those are the ones that you want to see at the top of your gain. A healthy economy is going to have a lot of growth in your manufacturing, your transportation of goods that are manufactured. You know, there's a ripple effect. When you build some type of widget, then you have to ship it, and then you have to sell it. I mean, there's a lot of value being added from after that. So when you look at this recovery out of the recession, and we did have a recession in 2022, we had 2 quarters of negative growth. You remember the Biden administration denied that that was actually a recession, but we did have a recession. And it seems as if we're, forecast at least for another recession in early 2024, the recession that seems to have never come. So back to the FX Hedge article. The increasingly prevalent belief among economists and talking heads alike is that we're much further along in a recovery than we actually are. The labor market, especially the private sector, is nowhere near the pre-pandemic trend. And what creates value, what creates wealth for a society, the private sector does. The government sector sucks wealth from the private sector. The government sector does not create or add value. They might create the conditions to add value, but they themselves do not create value. So going back here, I think we want to get the here we are here, the next paragraph that I thought was important here. The point here is not to highlight the labor market as an outlier, but to say that it's emblematic of the economy at large. We've never really recovered from 2020, 2021. This has just all become the new normal. And now we're fatigued waiting for the recession to come. And we're like, okay, it's not going to happen. We've already had, as I said, 2 negative quarters in 2022. And short, I mean, can't believe your lying eyes, but the economy isn't what it was in 2019, notwithstanding all sorts of political people that want to tell you that it's back, all sorts of people in the economic media that want to tell you it's back, like the Yahoo video. I could have brought up 19 different videos from mainstream economic news that wanted to tell you that it's back. The simple fact of that, when you look at the charts are undeniable where you have the pre-pandemic trend, and then we're way down here. I mean, that's just undeniable. People are not back to work. And if they are, they're back to work in healthcare and government, which does not add a sustainable value to the economy. So looking forward from here, what is crystal clear is that we might be headed into a situation where we have the dreaded stagflation, which of course the government will deny. But when you look at the inflation numbers, we are currently, and this brings in, what's going to happen tomorrow, because the CPI numbers are out tomorrow at 8:30. We'll be doing a live stream on that. When you look at these numbers, we are currently at a 4% CPI core. That's basically CPI minus food and energy. And that's the red on this chart. The headline CPI is lower at 3.2. And the expectations is that our CPI core is going to stay at 4%. Remember, the Fed target is 2%. So we're basically we're running the double rate of inflation than the Fed wants. And so what is it again? When you have inflation and a slow economy, that's known as stagflation. And we are running a distinct risk, especially with our continued borrowing, that we could be headed towards stagflation, whether or not the actual government wants to admit it or not. So if I was you, and I'm not a financial advisor or a lawyer, but I'd buckle down and make sure that you have your expenses in line and do everything that you can to optimize your opportunities economically going forward. All right. So I'm Jack from Jack Gately Real Estate in the Online Real Estate Academy. We'll probably be back later today for another video. Going to talk about Macy's and how it's a real estate takeover. And of course, we'll be back tomorrow for CPI on Tuesday, 8:30 a.m. Thanks so much for watching. We'll see you again. Bye-bye.